On June 3, 2026, Canada's Department of Finance released what looked like an almost bureaucratic announcement. Finance Minister François-Philippe Champagne confirmed that Canada would extend its steel and aluminum tariff measures for another full year. There was no dramatic press conference, no podium pounding, and no speech designed for cable news clips. Just a carefully worded commitment to building a stronger, more independent, and more resilient Canadian economy. But buried inside that dry procedural language was a decision with consequences far beyond Ottawa. Within days, it would reach boardrooms in Cleveland, Charlotte, and Pittsburgh. It would also reach the stock prices of three of America's largest steelmakers. This is the story of how a mid-sized northern economy, one that Washington has spent nearly 2 years treating as an afterthought in its trade wars, quietly began turning the tables on the very industry Donald Trump had promised to save. To understand why this moment matters, we need to return to the beginning of 2025, when the Trump administration reignited Section 232 tariffs on steel and aluminum. The tariff rate was doubled from 25% to 50%. The political logic was simple, and on the surface, popular. The goal was to protect American steelmakers from cheaper foreign metal, especially imports from Canada. For decades, Canada had been treated as a trusted partner under continental trade rules, not as a competitor that needed to be blocked by a tariff wall. At first, Wall Street loved the policy. When Trump pledged to double the tariff in the middle of 2025, shares of Cleveland-Cliffs, Steel Dynamics, and Nucor all surged the following Monday. Cleveland-Cliffs alone jumped 27% in pre-market trading. Investors saw a protected market, stronger margins, and a captive customer base with few alternatives for obtaining steel at scale. For several months, the situation developed almost exactly as the bulls had predicted. But protection is never free, and the bill arrived much faster than many people on Wall Street expected. Canada did not respond the way Washington appeared to assume it would. Ottawa did not simply absorb the tariffs, accept the loss of market share, and wait for the dispute to end. Instead, the Canadian government began rebuilding its entire trade posture from the ground up. By late December 2025, Canada had introduced a 25% tariff on steel derivative products worth roughly 10 billion Canadian dollars. The measures covered a wide range of goods, including doors, windows, wires, fasteners, bridges, and wind towers. At the same time, Canada sharply reduced tariff rate quotas for steel imports from countries without a free trade agreement. Those quotas were cut from 50% of 2024 import levels to just 20%. Any shipment above the quota would face a punishing 50% surtax. Canada kept its CUSMA carve-out fully intact for the United States and Mexico, but it began restricting nearly every other source of foreign steel entering the Canadian market. In practical terms, Ottawa was creating a protected zone for Canadian production and steel, supplied by its CUSMA partners. Then, in June 2026, Canada doubled down again. Ottawa extended the measures for another full year and gave no indication that it intended to blink first. This is where the story becomes deeply uncomfortable for the American steel executives who spent 2025 celebrating tariff protection. Cleveland-Cliffs, led by the famously combative Lourenço Gonçalves, made a major and highly visible bet in 2024. The company acquired Canadian steelmaker Stelco for roughly $2.5 billion. The logic appeared straightforward. Cleveland-Cliffs would integrate Canadian production capacity into an American steel giant, benefit from continental demand, and build what Gonçalves liked to describe as Fortress North America. The vision was a closed-loop steel ecosystem that could resist competition from Asia and Europe. Instead, the acquisition became a liability almost overnight. Stelco's sales were hit hard by the 50% United States tariff applied specifically to steel shipped from Canada. The irony was difficult to ignore. The tariff was designed to protect American steelmakers, yet it was now punishing the Canadian subsidiary of an American steel company. Gonçalves later called on the Canadian government to build higher trade barriers of its own. In effect, he was asking Ottawa to protect his newly acquired Canadian mill using the same kind of defenses Washington had already deployed against foreign suppliers. That is the trap at the center of this story. Cleveland-Cliffs bought a Canadian steelmaker to dominate the Canada-United States corridor. Then, United States tariff policy turned that same asset into dead weight almost as soon as the deal was completed. Meanwhile, Canada's retaliatory system began redirecting steel demand inward and towards CUSMA partners. but it was doing so on Canada's terms, not Washington's. The company's financial results began reflecting that structural pressure. Full-year revenue for 2025 fell by roughly 3% to $18.66 billion. During the first quarter of 2026, Gonçalves was forced to promise investors sequential improvement from one quarter to the next, while pointing to energy costs and delayed pricing as the main headwinds. Translated out of corporate language, the message was much simpler. Cleveland-Cliffs' flagship Canadian acquisition was under serious pressure, and the financial damage was becoming increasingly difficult to hide. The market did not wait patiently for management's reassurances. Throughout the first half of 2026, almost every signal from Washington about tariff policy sent steel stocks sharply higher or lower. Increasingly, those moves were downward. In February 2026, reports emerged that Trump was considering reducing the steel and aluminum tariffs to ease consumer price pressure ahead of the midterm elections. Shares of Nucor, Cleveland-Cliffs, and Alcoa all fell during the same trading session. Steel and aluminum companies were down between 5 and 6% at one point during the day. Investors were beginning to price in the possible return of foreign competition. At the same time, they were questioning how long the pricing cushion created by the tariffs could really last. Cleveland-Cliffs suffered a separate and even more severe blow only days earlier. The company missed fourth quarter revenue expectations by nearly $300 million. Soon afterward, its own chief executive sold 3 million shares worth more than $37 million. That sequence sent the stock down nearly 17% in a single trading session. It also raised uncomfortable questions among analysts about internal confidence in the Stelco acquisition. None of this happened in isolation. It unfolded against the backdrop of a Canadian government that had stopped playing defense and started building a parallel steel economy that increasingly did not require American capacity to function. This is the part of the trade war that much of the American coverage has missed. The popular narrative in the United States has been based on unilateral American leverage. Washington imposes tariffs, Canada suffers. End of story. But the underlying data tells a much more complicated tale. Steel imports into the United States declined by 12.2% during 2025, and that contraction continued into early 2026. On the surface, this appears to be a clear success for the tariff policy and for domestic steel producers. But falling import volumes cut in both directions. American manufacturers that depend on steel as an input, including automakers, construction companies, and appliance manufacturers, are now paying more for a supply that is both smaller and increasingly expensive. At the same time, Canadian producers that lost cheap access to the United States market are not simply shutting down and waiting for relief. With their own government placing quota walls around competing foreign suppliers, those producers are redirecting capacity toward domestic Canadian demand, European buyers under emerging frameworks, and CUSMA-compliant trade routes that avoid the worst tariff exposure. Canada is not losing this fight by standing still. It is actively rebuilding its economy around the tariffs. Washington's own steel producers, meanwhile, are quietly absorbing collateral damage from a policy that was supposed to protect them completely. Timing is what drives the next stage of this story. On April 2, 2026, the Trump administration issued another Section 232 proclamation. This one expanded tariff coverage to include copper for the first time, in addition to steel and aluminum. It also changed how tariffs were calculated for many derivative products. Under the new method, most derivative products would be taxed based on their full value rather than only the value of their metal content. For Canadian exporters, this closed a previously useful loophole almost overnight. Some companies had chosen not to claim CUSMA preferential treatment because doing so allowed them to receive a more favorable tariff calculation. But once the full value method was introduced, that strategy became far less useful. For many automotive and derivative products, CUSMA compliance suddenly became almost tariff neutral. Then, on June 1st, only 2 days before Ottawa announced its own extension, Trump signed another proclamation. This one temporarily reduced tariff rates from 25% to 15% on a limited group of goods, including agricultural equipment and residential heating, ventilation, and air conditioning systems. At the same time, the administration strengthened fraud penalties for importers accused of misrepresenting United States content in order to avoid tariffs. The reductions were explicitly temporary, and were scheduled to expire at the end of 2027. That built-in expiration date revealed just how unstable the entire framework had become. Companies on both sides of the border were being forced to make multi-year capital decisions under a tariff system that, in practice, had been changing approximately every 6 to 8 weeks. And all of this was happening immediately before the largest structural event in the entire North American trade relationship. The formal joint review of the Canada-United States-Mexico Agreement was scheduled to begin on July 1st, 2026, the day after this recording. This was not a minor administrative checkpoint buried in an appendix. The CUSMA review clause allowed all three governments to formally reassess the agreement and decide whether to extend it, renegotiate specific chapters, or allow critical provisions to lapse. Canada spent the period from September through November 2025, conducting an extensive public consultation to prepare its negotiating position. The government collected input from Canadian companies and industry associations about what was working, what was failing, and where Ottawa should push back most aggressively. The Canadian government had already indicated that it would be far less accommodating during this review than it had been during the original USMCA negotiations under the first Trump administration. Officials in Ottawa had spent much of the previous year quietly building the leverage they intended to bring to the negotiating table. That leverage included a parallel tariff system for steel from outside CUSMA, stronger domestic and regional supply chains, and an electorate that had watched its government refuse to fold for 18 consecutive months. Mark Carney's government approached the conflict with a posture that differed sharply from the conciliatory tone Canadian leaders had often adopted in earlier trade disputes with Washington. Rather than seeking a quick agreement simply to stop the immediate pain, Canada used the crisis to accelerate a much broader structural shift. Ottawa began diversifying trade relationships, strengthening domestic supply chains, and using retaliatory tariffs not only as punishment, but as a genuine instrument of industrial policy. The objective was to redirect demand toward Canadian and CUSMA-compliant producers for the long term. The steel and aluminum tariff extension announced on June 3rd was not presented by Champagne as a defensive retreat. It was described as part of the effort to build a stronger, more independent, and more resilient Canadian economy. That language carried a clear message. Ottawa increasingly viewed the confrontation as an opportunity to reduce Canada's long-term dependence on the American market, not merely as a temporary crisis to survive before returning to business as usual. For the American steel industry, that shift in thinking represented the nightmare scenario hidden inside what had initially looked like a protectionist victory. Nucor performed better than most of the major companies. Its shares posted a 16% year-to-date gain through early 2026 and a 41% return over 12 months. A major reason was the company's domestic, scrap-based electric arc furnace model. That structure protected Nucor from much of the cross-border exposure that damaged Cleveland-Cliffs. But even Nucor's first quarter guidance showed meaningful weakness. The company said its steel mill segment would perform roughly in line with the fourth quarter, when earnings had already fallen 71% from a year earlier. Its steel products segment was expected to decline further after posting a year-over-year drop of nearly 50% in the previous period. Steel Dynamics remained the steadiest of the group. The company offered a reasonable dividend yield and maintained a strong buy consensus among analysts who saw resilience in its diversified product mix and its relatively limited exposure to the Canadian border dispute. United States Steel faced a different problem. The company, perhaps the most symbolically important name in the American steel industry because of its history and recent ownership controversy, remained trapped in what analysts described as acquisition limbo. Consensus ratings stayed near hold, while some projections suggested another 14% of potential downside from current levels. The market was still waiting to understand where United States Steel would fit inside the new tariff landscape. What ties all of this together is a tariff system that has become extraordinarily complicated. The structure is now layered across Section 232, Section 122, CUSMA preferential treatment, product-specific exemptions, and stacking rules that determine how different tariffs interact. Even experienced trade lawyers and major accounting firms have struggled to follow the changes in real time. Canadian tax advisors spent much of 2026 publishing repeated bulletins just to track the sequence of presidential proclamations. The order in which tariffs apply can dramatically change the final cost of a shipment. Whether a company claims a CUSMA exemption, pays the Section 232 rate, or qualifies for a narrow annex carve-out can change its effective tariff by tens of percentage points on the exact same product. The legal foundation of the system has also become increasingly fragile. After the Supreme Court's February 20th, 2026 ruling on tariff authority, the administration shifted towards Section 122 of the Trade Act of 1974. That provision allows only temporary import charges, and by law, cannot remain in force for more than 150 days without an extension from Congress. That limitation means the tariff structure supporting this entire conflict could be challenged, modified, or partially overturned again before the CUSMA review is completed. For executives planning capital investments on either side of the border, that creates yet another layer of uncertainty. So what happens after July 1st? The honest answer is that nobody has a confident answer. Not the steel executives, not the trade lawyers, and not the analysts at TD Economics or RBC Wealth Management, who have been studying these scenarios for months. The review was designed to bring forward exactly the disagreements that had been building since early 2025. The United States entered the review having achieved real results. Steel import volumes had fallen. Domestic pricing had been protected for companies such as Nucor, and the 50% baseline tariff remained fully intact. The Office of United States Trade Representative Jameson Greer described the steel and aluminum tariffs as incredibly successful, while also acknowledging that some changes could still be introduced to reduce compliance burdens for industry. Canada entered from a very different position. Ottawa had built an alternative structure that was becoming less dependent on American steel demand. It had extended its own protective measures through the middle of 2027. And it had spent more than a year showing Canadian voters and global markets that it would not absorb American tariff pressure without responding deliberately and repeatedly. The steel industry stood at the center of this collision because steel had never been just another commodity in the dispute. It had become the proof of concept for tariff nationalism itself. Can a government truly protect an industry by walling off its domestic market? Or does the policy simply move the pain through the supply chain until someone is forced to absorb the loss? That loss could fall on a Canadian mill. It could fall on an American manufacturer paying higher input costs. Or it could fall on a steel executive watching a prized Canadian acquisition underperform quarter after quarter. Cleveland-Cliffs bet that owning Canadian production would allow it to dominate both sides of the border at the same time. Instead, the company became collateral damage in a trade conflict started by its own government. Canada made a different bet. Ottawa believed that retaliation, combined with a deliberate domestic industrial strategy, could offset the loss of preferential access to the United States market. So far, that strategy appears more sustainable than Wall Street initially expected when the tariffs were first announced. What is certain is that July 1st was never going to mark the end of the dispute. It was an escalation point. It was the moment when three governments would sit down and decide whether the rules governing $3.6 trillion in annual North American trade still made sense in a world where those same rules had been repeatedly rewritten by proclamation. The outcome of the review would determine whether the steel industry's volatility was only a temporary disruption on the road back to Fortress North America, or the first visible crack in a continental trade relationship that both governments were now willing to test to its absolute limit. And neither Ottawa nor Washington appeared ready to be the first side to step back. Do you see Canada's strategy as a temporary defensive response or the beginning of a lasting shift in North American industrial power? Share your view in the comments. We will continue looking beyond the tariff headlines and following the deeper structure behind this trade conflict. Subscribe to stay with us as the next stage unfolds.